Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're taking a closer look at the surprising developments in Canadian inflation and the significant rise in property taxes. Recent data from Statistics Canada shows that the Consumer Price Index, or CPI, made a sharp climb in October, reversing the decline observed in previous months. The annual growth of the CPI increased by 0.4 percentage points, reaching 2.0%, the same level it was at in August. This uptick has caught many by surprise, especially since it was driven by smaller declines in energy prices and a notable rise in grocery and transportation costs. Core inflation, which strips out the more volatile components of the CPI, climbed even higher, reaching 2.5% in October. This is particularly concerning because it suggests that inflationary pressures are becoming more entrenched, with the core measure nearing the upper bound of the Bank of Canada's target range. Interestingly, the shelter cost component of the CPI showed some deceleration, though it remains elevated. The CPI shelter index fell by 0.2 percentage points to an annual growth rate of 4.8% in October. This was partly due to reduced mortgage interest costs, which dropped significantly from the levels seen in August 2023. However, the inclusion of mortgage interest costs in the CPI is often criticized for creating a circular issue, as interest costs depend on inflation, and inflation readings include interest costs. One of the most striking figures from the recent data is the surge in property taxes and special charges, which saw an annual growth of 6.0% in October, the highest since 1992. This increase reflects the lag between rising property values and the cost of carrying services such as waste management and local municipal services, which are impacting homeowners across all provinces. Despite these inflationary pressures, major banks like RBC are still expecting the Bank of Canada to proceed with another 50 basis point cut to the overnight rate in December. This expectation is based on the belief that the recent uptick in inflation is transitory, as previously noted by the Bank of Canada in their July monetary policy report. However, some experts are questioning the central bank's previous rate decision, especially following a major revision by Statistics Canada that showed the economy was performing better than initially thought. This revision eliminated the output gap, suggesting the economy is closer to excessive demand than previously believed. As a result, while the expectation for a rate cut remains, it is subject to change as new data emerges. Recent developments have cast doubt on the likelihood of another 50 basis point rate cut from the Bank of Canada in December. The recent inflation report for October showed a stronger than expected increase, with the annual headline inflation rate reaching 2.0%. This was above the 1.9% forecast by economists and a noticeable rise from September's 1.6% figure. The primary drivers behind this increase were higher gasoline prices, property taxes, and base year effects, which can skew year-over-year comparisons. Despite the fluctuations in the headline inflation rate, core inflation measures, which exclude volatile items like food and energy, also rose in October. This movement prompted bond markets to lower the chances of a follow-up 50 basis point rate cut at the Bank of Canada's December 11th policy meeting to 23%, down from nearly 40% prior to the inflation report. Douglas Porter, the chief economist at BMO, commented on the situation, stating that the recent inflation data should temper expectations for another 50 basis point rate cut in December. Porter has maintained a 25 basis point cut expectation from the beginning, citing evidence of a stirring housing market, a cautious stance from the Federal Reserve, and a struggling Canadian dollar as reasons to support this outlook. However, there remains a possibility of another half-point cut. Several economists highlight that upcoming reports such as the third quarter GDP and November's employment data, might reveal a weakening Canadian economy, which could influence the Bank of Canada's decision. The central bank has acknowledged the potential for inflation data to fluctuate, suggesting it may not overly rely on a single month's results when making its rate decisions. Michael Davenport of Oxford Economics emphasized that a single month does not establish a trend, and the Bank of Canada is prepared for some volatility in inflation data in the near term. He believes that with inflation on target, a weak economy, and a loose labor market, the central bank is still likely to implement another 50 basis point cut in December. RBC economist Abby Hsu also supports the possibility of a half-point cut next month, pointing out that the 3-month annualized core inflation measures remain within the bank's target range of 1% to 3%. She also notes the continued softness in the labor market, with a rising unemployment rate, as factors that could justify a larger rate cut. Catherine Judge, an economist at CIBC, acknowledges the uncertainty surrounding the Bank of Canada's upcoming decision. While the latest inflation report may have disappointed the central bank, it follows a series of reports showing more significant progress than anticipated. Judge suggests that the expected slack in the Canadian economy, confirmed by forthcoming labor market and GDP reports, supports the likelihood of a 50 basis point cut in December. Today, we're examining the latest data released by the Canada Mortgage and Housing Corporation, which sheds light on the current state of housing, starts across the country, and their impact on affordability. The data reveals a mixed picture, with some regions experiencing growth while others face declines. In October, the 6-month moving average of the seasonally adjusted annual rate for all housing starts nationwide was essentially flat at 243,522 units. This stagnation in housing starts is a critical factor in the ongoing affordability crisis, as the supply of new homes isn't keeping pace with demand. When looking specifically at urban centers, the actual housing starts year-to-date show little change from last year. In 2024, there were 188,567 starts, compared to 187,722 in 2023. While there was a 6% rise in the monthly seasonally adjusted annual rate for total urban units, this increase was primarily driven by a 7% gain in the multi-unit segment compared with just a 1% rise for single detached homes. The data highlights an uneven landscape across Canada. Toronto and Vancouver, which had a strong year for housing starts in 2023, experienced significant decreases of 24% and 18% respectively for the first 10 months of this year. In contrast, Montreal saw a 12% rise in housing starts during the same period. However, there were some positive signs in the monthly seasonally adjusted annual rate for housing starts, with Toronto up 44%, Vancouver up 30%, and Montreal up 25% in October. This uptick is a promising sign for Ontario and British Columbia, as these increases contributed to the national seasonally adjusted annual rate rise in October. Bob Dugan, the chief economist at CMHC, commented on the situation, stating that while the actual year-to-date housing starts are similar to last year, higher activity is observed in the Prairie provinces, Quebec, and the Atlantic provinces. Meanwhile, Ontario and British Columbia have seen declines across all housing types. Despite the recent increases in the monthly seasonally adjusted annual rate in Toronto and Vancouver, Dugan emphasized that these results still fall short of the levels needed to restore affordability in Canada's urban centers. Interestingly, the latest Scotiabank housing poll indicates that despite these challenges, the desire for home ownership remains strong among younger Canadians. This persistent demand underlines the urgency for addressing housing supply issues to ensure that affordability is within reach for aspiring homeowners. Let's delve into a recent study by the Smart Prosperity Institute, which highlights a concerning trend in Ontario's homebuilding efforts over the past 6 years. The study indicates that Ontario has consistently lagged behind other provinces in terms of homebuilding per capita. Specifically, data for 2024 suggests that the situation is worsening, with Ontario starting 13,000 fewer homes between January and October compared to the same period last year. In contrast, the rest of Canada started 14,000 more homes on average during the same time frame. The report, authored by Mike Moffat, an economist and senior director of policy and innovation at the Smart Prosperity Institute, evaluates Canada's 100 largest municipalities in their efforts to meet housing demand. The study found that Ontario municipalities are predominantly positioned at the lower end of the spectrum when it comes to home building per capita. Notably, only 3 Ontario communities, Pickering, Oakville, and Kitchener, ranked in the top 20 municipalities, while British Columbia had 8 and Quebec had 4. In stark contrast, 13 of the bottom 20 spots for per capita home building were filled by Ontario towns and cities, including Aurora, Brampton, Peterborough, St. Catharines, Ajax, Windsor, Burlington, Halton Hills, Sarnia, Sault Ste. Marie, Sudbury, Thunder Bay, and North Bay. On a more positive note, Toronto managed to rank in the top 20 for per capita apartment unit starts, although it was the only Ontario city to do so, and it still lagged behind cities like Burnaby, Moncton, and Gatineau. When it comes to home building per 100 new residents, Ontario was positioned 8th, ahead of only New Brunswick and Saskatchewan. This ranking underscores the challenges faced by the province in addressing its housing needs. Economist Mike Moffat has pointed out that some of the worst-ranked cities, such as Brampton, St. Catharines, and Windsor, are led by mayors who have called on the provincial government to use the notwithstanding clause to clear homeless encampments, which raises significant ethical and legal concerns. Mike Moffat suggests that the solution lies not in infringing on constitutional rights, but rather in implementing government actions that focus on building more homes. He advocates for substantial reforms at both the provincial and municipal levels, including changes to zoning and development charges. Moffat warns that without such reforms, Ontario could face an exacerbated housing crisis with increased homelessness, low vacancy rates, soaring rents, and heightened food bank usage. The report also highlights a worrying trend of people leaving Ontario for other provinces, seeking better living conditions. Over the past 4 years, Ontario has experienced a net outflow of over 100,000 people, resulting in what is often referred to as a brain drain. This movement underscores the urgent need for policy changes to improve housing availability and affordability in Ontario, to retain its skilled workforce and support economic growth. Mortgage brokers are gearing up for intense competition as the housing market shows signs of heating up. This resurgence is largely driven by lower interest rates and evolving market dynamics. According to the Canadian Real Estate Association, home sales in October surged to their highest level in over 2 years, with a 7.7% increase from the previous month. This spike in sales comes as the benchmark home price slightly decreased by 0.1% to $716,800, creating a temporary window of opportunity for potential buyers. The recent rate cuts by the Bank of Canada seem to have revitalized buyer interest after a period of uncertainty. Mortgage brokers are noticing a significant uptick in pre-approvals, which suggests that many prospective buyers are no longer holding out for further rate reductions. Leah Zlatkin, a licensed mortgage broker and expert with lowestrates.ca, shared insights with bnnbloomberg.ca, noting the notable increase in sales alongside a drop in new listings. She highlighted that this, combined with new mortgage rules set to take effect on December 15th and anticipated further rate cuts by the Bank of Canada, is expected to intensify competition. Zlatkin pointed out the significant rise in mortgage pre-approvals, indicating that many buyers are closely monitoring the market for the perfect timing. Homebuyers who were previously hesitant are now actively participating, evaluating their options, and questioning whether fixed or variable rates are more suitable in the current climate, she explained. Zlatkin emphasized that for those contemplating a home purchase, the opportunity is fleeting, and now is the optimal time to act before the market shifts in favor of sellers. Victor Tran, a mortgage and real estate expert at Rates.ca, echoed these sentiments, noting the renewed activity in the housing market is beneficial for both buyers and sellers. Tran suggested that if the Bank of Canada implements another significant rate cut in December, it could alter buyer psychology, potentially leading to a bustling winter season. He mentioned that this influx of buyers could rapidly heat up the market and drive home prices upward. Tran added, "These buyers have pre-approvals and are searching for the right time and property to purchase. Once the momentum shifts and buyers enter the market in large numbers, we can expect the market to heat up quickly, accompanied by a rise in home prices. In some positive news from the real estate sector, Happy Belly Food Group Inc. has announced the securing of a new location for its Via Cibo franchise in Barrhaven, a suburb of Ottawa, Ontario. This move marks the establishment of Via Cibo's first multi-unit franchisee, as the existing franchisee, who has already found success with a location in Canada, expands their operations. Via Cibo brings a unique offering to the table with its fast-casual Italian street food, made with traditional ingredients and a chef-driven culinary experience. The new location is set to open in Chapman Mills Marketplace, an area that boasts anchor tenants like Loblaws, Walmart, and Cineplex Odeon, making it a promising spot for high-foot traffic. Sean Black, the chief executive officer of Happy Belly, expressed excitement over the expansion, highlighting the potential of Barrhaven as a rapidly growing suburb. Known for its strong residential growth, Barrhaven is home to a diverse community of young families, professionals, and retirees, all of whom are seeking vibrant dining experiences. This makes it an ideal location for a new Via Cibo outlet. The decision to expand into Barrhaven is part of Happy Belly's broader strategy to grow its emerging food brands, not only in Ontario but also across Western Canada. The company believes that its franchising program will be crucial in driving both revenue and profitability. With this expansion, Happy Belly continues to reinforce its presence in the food industry by securing high-quality franchisees and prime real estate locations. The company currently has over 421 contractually committed retail locations across its portfolio, reflecting its commitment to growth and innovation. As Happy Belly pushes forward with its expansion plans, the company is focused on opening new stores and supporting its franchisees through an asset-light franchising model. This approach allows them to scale efficiently and meet the growing demand for diverse culinary options while maintaining high standards of quality and service. As we wrap up today's episode, we can see that the real estate landscape in Ontario continues to evolve with new developments and opportunities. The expansion of Via Cibo in Barrhaven is just one example of how businesses are adapting to meet the needs of growing communities across the province. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.